Today we are talking about successful share market strategy. There are many things to consider when formulating a share market strategy. The following are 5 tips that can help you create a successful strategy. Firstly, have a clear investment objective. What are you looking to achieve by investing in shares? Do you want to generate income or grow your capital? This will help you determine what kind of shares to buy and how long to hold them for. Secondly, consider the risks involved. The share market can be volatile, so it's important to understand the risks before you invest. Make sure you diversify your portfolio to spread the risk and only invest money you can afford to lose. Thirdly, don't buy shares just because they're going up in price. It's important to do your research and only buy shares in companies that you believe in. When the share price falls, you're more likely to hold on to your shares if you believe in the company's long-term prospects. Fourthly, don't try to time the market. It's impossible to predict when share prices will go up or down, so don't try to second-guess the market. 1. Research the share market and understand how it works. 2. Have a clear investment goal and time frame in mind. 3. Start small and gradually increase your investment. 4. Diversify your portfolio. 5. Review your portfolio regularly and rebalance it. 6. Have a disciplined approach and stick to your strategy. 7. Have patience and don't try to time the market. 1. Research the share market and understand how it works. The first step to formulating a successful share market strategy is to have a strong understanding of how the share market works. This means doing extensive research on the topic and understanding all the key concepts involved. When researching the share market, it is important to understand the different types of market structures and the ways in which they operate. The 2 most common types of market structures are the bull market and the bear market. In a bull market, prices are rising and investor sentiment is generally positive. This is typically seen as a good time to buy shares, as you can expect prices to continue to rise. In a bear market, prices are falling and investor sentiment is generally negative. This is typically seen as a good time to sell shares, as you can expect prices to continue to fall. It is also important to understand the different types of shares that are available on the market. The 2 most common types of shares are common shares and preference shares. Common shares give the holder the right to vote on company matters and to receive dividends. Preference shares give the holder the right to receive dividends but do not give the holder the right to vote on company matters. When formulating your share market strategy, it is important to consider your risk tolerance. Risk tolerance is the level of risk that you are willing to take on in order to achieve your investment goals. There are 2 main types of risks involved in the share market: market risk and company risk. Market risk is the risk that the overall market will decline, which will affect the value of your shares. Company risk is the risk that the specific company you have invested in will perform poorly, which will also affect the value of your shares. There are a number of different strategies that can be employed, and it is important to find one that suits your needs. Some common strategies include buying shares in companies that are undervalued by the market, buying shares in companies with strong fundamentals, and buying shares in companies that are experiencing positive momentum. 2. Have a clear investment goal and time frame in mind. Investing in the share market can be a great way to grow your wealth over the long term. However, it's important to have a clear investment goal and time frame in mind before you start investing. 3. Start small and gradually increase your investment. When it comes to investing in the share market, there is no one-size-fits-all approach. What works for one investor might not necessarily work for another. One of the most important things to remember is to start small and gradually increase your investment. Investing a large sum of money all at once can be a risky move, and it is often better to gradually increase your investment over time. This way, you can get a feel for how the market works and what types of investments are likely to be successful, before putting all of your eggs in one basket. Another tip is to diversify your portfolio. Don't just put all of your money into one company or one type of investment. By spreading your risk, you are more likely to see a return on your investment, even if one particular company or sector doesn't perform as well as you had hoped. Finally, keep your emotions in check. The share market can be a volatile place, and it is important to remember that prices can go up as well as down. Don't make any rash decisions based on your emotions, and always do your research before investing in anything. By following these tips, you can give yourself a better chance of success when investing in the share market. 4. Diversify your portfolio. Investing in the share market can be a great way to create wealth over the long term. One of the best ways to reduce the risks associated with investing in the share market is to diversify your portfolio. This means investing in a range of different companies and sectors, rather than putting all of your eggs in one basket. Diversifying your portfolio can help to protect you from the potential for losses if one particular company or sector performs poorly. It also allows you to take advantage of different growth opportunities that may arise across different companies and sectors. There are a few things to keep in mind when diversifying your portfolio. 1. Don't put all your eggs in one basket. As we mentioned, diversifying your portfolio can help to reduce the risks associated with investing in the share market. 2. Consider different types of investments when diversifying your portfolio. You should consider investing in a range of different types of assets. This could include shares, property, fixed interest, and cash. 3. Consider different companies and sectors. It is also important to consider diversifying across different companies and sectors. This will help to reduce the risks associated with investing in any one particular company or sector. 4. Review your portfolio regularly. Once you have diversified your portfolio, it is important to review it on a regular basis. This will help you to make sure that your portfolio is still diversified and that your investments are performing as you expect them to. 5. Review your portfolio regularly and rebalance it. It is essential to review your portfolio regularly and rebalance it to ensure you are still on track to achieving your financial goals. If your goals have changed or your circumstances have changed, then your portfolio mix will need to change too. For example, if you are now retired and living off your investments, you will need a different mix of assets to someone who is still working and saving for retirement. Regular rebalancing also ensures that you are buying low and selling high. Over time, some assets will rise in value more than others. By selling the assets that have increased in value and buying more of the assets that have decreased in value, you will bring your portfolio back into balance. There is no set rebalancing schedule that will suit everyone. It will depend on your individual circumstances and goals. If you don't have the time or the expertise to review and rebalance your portfolio yourself, you can always seek professional help. A financial advisor can provide valuable guidance on how to achieve your financial goals. When it comes to having a successful share market strategy, it is important to have a disciplined approach and stick to your strategy. This means being disciplined in your research, analysis, and execution. It also means having the discipline to stick to your strategy even when it is not working out in the short term. There are a few things you can do to help make sure you stick to your strategy. First, it is important to have a clear and well-defined strategy. This will help you stay focused and on track. Second, you need to be patient and stick to your plan even when things are not going your way in the short term. Lastly, you need to be willing to adjust your strategy as needed. This means being flexible and open to change. While it is important to have a disciplined approach, it is also important to remember that the share market is unpredictable. This means that there will be times when your strategy will not work out as planned. However, if you stick to your strategy and are patient, you will eventually be successful. Trying to time the market is a fool's errand. The only way to make money in the markets is to have patience and invest for the long term. You need to be in it for the long haul if you want to make money. The best way to make money in the markets is to invest in good companies and hold them for the long term. This strategy is called buy and hold. There are a few reasons why this is the best strategy. First, good companies tend to grow over time. They increase their sales, profits, and dividends. This growth is reflected in the stock price, so you'll make money if you hold the stock for the long term. Second, you don't have to worry about timing the market. All you need to do is invest in good companies and hold on to the stock. Third, you'll save money in fees and commissions. You'll only need to buy and sell once if you hold the stock for the long term. Fourth, you'll avoid the risk of buying at the top of the market and selling at the bottom. There are two risks you need to be aware of when you invest in the stock market. The first is called market risk. This is the risk that prices will go down in the future. The second is called individual stock risk. This is the risk that a particular stock will go down in value. The best way to avoid these risks is to diversify your portfolio. Diversification is a technique that reduces risk by investing in a variety of assets. You can diversify your portfolio by investing in different types of stocks, bonds, and other assets. The best way to diversify is to invest in a low-cost index fund. Index funds are a type of mutual fund that track a market index, such as the S&P 500. Index funds are a good way to diversify because they invest in a large number of companies. This diversification reduces the risk of any one company going bankrupt. Index funds are also a good way to diversify because they're low cost. The expense ratio of an index fund is the percentage of the fund's assets that are used to pay the fund's expenses. The average expense ratio of an index fund is 0.20%. This means that for every $100 you invest in an index fund. If you're thinking of investing in the share market, these 5 tips will help you develop a successful strategy. Firstly, do your research and make sure you understand how the share market works. Secondly, develop a clear investment plan and stick to it. Thirdly, be patient and don't try to time the market. Fourthly, diversify your portfolio and don't put all your eggs in one basket. Finally, don't let your emotions get the better of you and always remember that the share market can go up as well as down. By following these tips, you'll give yourself the best chance of success in the share market. Thank you for watching this video. Please like, share and subscribe to my channel. Till then, take care of yourself and your family. Goodbye.